Short selling is a type of trading or investing in which forecasts are made regarding the decline in value of a stock or other security. Only experienced investors and traders should take advantage of this complicated strategy. While traders may use short selling for speculation, investors or portfolio managers may use it to protect against the downside risk of a long position in the same security or one that is similar. A sophisticated form of trading with a high potential risk is speculation. Hedging, which entails taking an opposing position to reduce risk exposure, is a more frequent transaction. So, want to know more about short selling in the stock market? Well, here we go. In short selling, a position is established by obtaining borrowed shares of a stock or other asset, the value of which the investor anticipates falling. The investor then sells these borrowed shares to purchasers who are willing to pay the market price. In order to purchase the borrowed shares for a lower price before they must be returned, the trader is hoping that the price will continue to decline. The risk of loss on a short sale is essentially limitless because the price of any asset can increase indefinitely. When a seller engages in short selling, they open a short position by borrowing shares, typically from a broker-dealer, to repurchase them at a profit if the price falls. Shares must be borrowed since you cannot sell shares that do not exist. When a trader wants to close a short position, they purchase the shares again on the market, ideally for a lower price than they were originally lent, and then they sell them back to the broker or lender. The trader must account for any interest or commissions assessed by the broker. To start a short position, a trader needs a margin account, and while the position is open, they frequently have to pay interest on the value of the borrowed shares. Additionally, the New York Stock Exchange, the Federal Reserve, and the Financial Industry Regulatory Authority, Inc., which oversees licensed brokers and broker-dealer firms in the U.S., have established minimum values for the amount that the margin account must maintain. The maintenance margin is the name of it. More money is needed if an investor's account value goes below the maintenance margin, or the broker may sell the position. The broker is in charge of finding shares that can be borrowed and returning them after the trade. With most brokers, the trade can be opened and closed using the standard trading interfaces. However, each broker will have specifications that must be met before they approve margin trading. Why sell short? The two main arguments for short selling are hedging and speculation. The sole bet of a speculator is that the price will decrease in the future. They will have to buy the shares back at a higher price and a loss if they are mistaken. Because short selling involves more risks due to the usage of margin, it is typically done over a shorter period and is therefore more likely to be done for speculative purposes. Additionally, short sales can be made to protect long positions. For instance, to lock in profits, you might want to sell short against a position in call options, which are long positions. You might also sell short a stock that is highly connected with the stock you are holding if you want to limit downside losses without really selling out of your long position. Let's see an example of short selling for profit. Consider a trader who predicts that the $50 per share XYZ stock will drop in value over the following 3 months. They sell 100 borrowed shares to another investor. Since the trader sold something that they did not own but had borrowed, they are now short 100 shares. Only by borrowing the shares, which might not always be possible if the stock is already heavily shorted by other traders, was the short sale made possible. After the company whose shares were shorted released dreadful quarterly financial data a week later, the stock drops below $40. To replace the borrowed shares, the trader chooses to close the short position and purchase 100 shares for $40 on the open market. Excluding commissions and interest on the margin account, the trader made $1,000 on the short sale. An illustration of short selling at a loss. Let's assume that in the aforementioned scenario, the trader decided to hold on to the short position rather than closing it out at $40 to profit from a further price decline. However, a rival steps in to make a takeover offer of $65 a share, and the price jumps as a result. The loss on the short sale would be $1,500 if the trader chose to close the short position at $65. In this case, the trader had to cover their position by purchasing the shares again at a substantially higher price. An example of a hedge using short sales. In addition to speculating, short selling serves the helpful aim of hedging, which is frequently viewed as the safer and more reputable version of shorting. Hedging's main goal is protection, as opposed to speculation's sole focus on profit. Hedging is done to safeguard gains or lessen losses in a portfolio but because it is expensive, the great majority of individual investors don't think about it very often. Hedging involves two expenses. Then there is the real cost of placing the hedge, which includes the fees for short sells or the premiums for protective options contracts. If markets continue to rise, there is also the lost opportunity cost of capping the portfolio's gain. For a straightforward illustration, assume that 50% of a portfolio that closely resembles the S&P 500 index is hedged. If the index increases by 15% over the ensuing 12 months, the portfolio would only experience about half of that gain, or 7.5%. If the short seller predicts the price movement incorrectly, it could cost them money. If a trader purchases stock, they can only lose their entire investment if the stock decreases to zero. A trader who shorts a stock, however, risks losing considerably more than their initial investment. The risk arises from the fact that a stock's price has no upper limit and can increase to infinity and beyond, to use a term from Buzz Lightyear, a different cartoon character. Additionally, the trader had to fund the margin account while the equities were held. Even if everything goes according to plan, traders must include the expense of the margin interest when estimating their profits. So what are the advantages? Potential for high profits, little upfront money needed, possible leveraged investments, defend other holdings with a hedge. Also, you should consider some drawbacks of it. Possibility of limitless losses, a margin account is required, accrued margin interest, brief squeezes. If many other traders are also shorting the stock, or if the stock is thinly traded, a short seller might have trouble finding enough shares to buy when it comes time to close a position. Conversely, if the market or a particular stock starts to soar, sellers may find themselves in a short squeeze loop. On the other hand, high-risk tactics also come with high returns. Short sales are not an exception. Sellers who utilize margin to start trades stand to gain handsome returns on their investments (ROI) if they properly forecast price movements. Leverage is made possible by using a margin, which implies the trader needed to deposit less money initially. Short selling can be a prudent, low-cost hedging strategy that acts as a counterbalance to other portfolio assets. In general, novice investors should refrain from short selling until they gain more trading expertise. However, because there is less of a chance of a short squeeze, short selling using ETFs is a little safer technique. Instead of betting on the market's overall direction, shorting includes betting against the direction of a stock's price. In addition to the standard trading commissions that must be paid to brokers, short selling entails hefty costs. To prevent panic and undue selling pressure, regulators may impose limits on short sales in a particular industry or even the entire market. The hard-to-borrow fees on shares that are difficult to borrow can be fairly high. An annualized rate is used to determine the fee, which can be anything from a very small percentage to more than 100% of the value of the short trade. Dividend payments on the shorted stock must be made to the organization that borrowed the stock from the short seller. Due to the possibility that a sizable portion of the stock's decrease may have already taken place, entering the trade too late may result in a significant opportunity cost in terms of lost gains. As a result, traders who adhere to the mantra, "the trend is your friend," stand a better chance of making money on short sales during a bear market than they would during a bull market. As in the global bear market of 2008-09, short sellers thrive in situations where the market decline is quick, wide, and steep because they stand to gain unexpected profits. For the overall market, deteriorating fundamentals could be characterized by a string of weaker data points that point to a potential economic slowdown, unfavorable geopolitical developments like the threat of war, or bearish technical indicators like new highs on declining volume and worsening market breadth. Experienced short sellers would opt to hold out on placing short trades until the negative trend is established, rather than doing so in anticipation of a downward move. This is due to the possibility that a company or market could continue to rise despite weakening fundamentals for several weeks or months, as is frequently the case in the closing stages of a bull market. The bearish trend is confirmed by technical indicators. When various technical indications support the negative trend, short sales may also be more likely to succeed. Occasionally, valuations for specific industries or the market as a whole may rise to extremely high levels due to the unbridled optimism on the long-term prospects of such industries or the overall economy. Experienced short sellers may wait until the market or sector rolls over and starts its downward phase before jumping in on the short side. When the aforementioned conditions coincide, then is the best time to short sell. So what do you think? Are you going to learn short selling? Share your thoughts in the comments section below. Subscribe to the channel to get our videos regularly, and don't forget to click the bell icon to never miss an update. We'll see you at the next one. Until then, peace.